Yeah, hello everybody. Here is again value-added tax and again an exercise case. But I promise you this will be the last one now for a long time because afterwards we are going to a new sub-chapter. Well, but we still have to deal with this here. The situation is simply explained or quickly explained. A from Aachen in Germany sells a machine to B from Brussels. Now B from Brussels, however, asks A, don't bring that machine to Brussels. Please bring it directly to my own customer C in Calais in France. Now, what do you do if a customer has such a wish? Uh, Naturally, you give in. So A does so and carries the machine immediately from Aachen to Calais in France and hands over the machine to C and then sends the invoice to B in Brussels to his contract partner, 200,000. All persons involved have very good accountants, and so in all stages of these transactions they use the VAT identification numbers of the correct states, so of those states of which they need to use the numbers. Well, that's plainly and simply what's going on. However, you know the trick already, what we always do, or at least what I want you to do always. That's to find out what's happening here. Let's look on the contracts. We have here two contract relationships. A has a contract with B and B has a contract with C in Calais. Now, evidently, when A has to hand over ownership in a machine to B, then B can only pass on the ownership in that machine after he has got it. So there is a logical time sequence here. The transaction A delivers to B must happen before the transaction B delivers to C can begin. That's already an important step. Now A definitively takes the good and sends it away from Aachen. So the good during this contract goes from Aachen to the address to which B has demanded it to be delivered, so to France. Because remember, B doesn't want the machine at Brussels. B says, bring it directly to the place where I myself need it, and that's in France, at an address of a certain guy called C in Calais. Knock on the door, say you come from me, you bring the machine, and when C signs a receipt, then you have delivered to me, B from Brussels. Afterwards, then, B can immediately pass on ownership from himself to C in Calais. The machine is already in Calais, so it stays at the same spot, only ownership hops over the machine, stays quiet. This is what happens. And now we see only during the first transaction the machine crosses the border. During the second transaction, this is evidently an internal French case. By the way, this is called, as you perhaps already know, a so-called chain transaction. That means one and the same tangible good is sold several times after another, but that good is then immediately and directly sent from the first person in the chain to the last person in the chain. So that's just the definition. And chain transactions sometimes are seen by some people as especially complicated or so. However, if you look to our sketch, you can immediately obtain all the information which you need because this chain transaction does not contain anything special. It's just the normal rules. So the treatment of the first contract is as follows. Let's look contract A and B. The first step in an internal case in the EU is always look to the customer. Is the customer somebody who can be charged with acquisition tax in the country? So is the customer somebody who can read and write, who knows about the value of the tax rules, or is it a private person? And here we see B is an entrepreneur, so B knows the rules. So there will be the solution that B has to pay the tax and the deliverer A will be tax-free. So let's test and prove this. 1, number 1, or the corresponding rule in French law. 1A, 1, number 1. The good crosses indeed the border from Germany to France. 1A, number 2. The buyer, B, is an entrepreneur, so that's fulfilled. And the seller is also an entrepreneur and not a small entrepreneur. So it is by definition an intra-community acquisition which triggers taxation. However, in which country? 3D, sentence 1. Says basic rule, where the transport ends, where the good is at the end of the delivery, that's in France. And now if our buyer uses the number of a wrong state, so the VAT identification number of Belgium perhaps, that would trigger an additional place of the acquisition in Belgium. Now the case data said they all use the VAT identification number of the correct state, so he uses a French number, and so nothing changes. That is only taxable in France. Okay, now let's go on. What happens next? Do we have a tax exemption for the acquirer? And for B USDG, which has a corresponding rule in France, in all probability, due to EU rules, you know that. VAT is nearly identical everywhere, although the text of the laws are different. For B doesn't have an exception, so it's in all probability liable to tax in France too. We have a tax base, that's the net amount in that transaction, 200,000. The tax rate and tax, there makes no sense to speak about 19% or the French corresponding percentage to 19% or so. You can only say the French rate for this machine. That's the only precise thing we can say if we don't know French law. The customer, that's B, is the taxpayer. The rest of the formalities is according to French law because it's taxable in France, so French law applies. We can't see anything special here. Input tax, B will be able to obtain input tax deduction for the acquisition tax. That's 15.1 number 3 in our law, and the French will have a corresponding rule because you know EU harmonization. The transaction, how is it treated in the country of the seller, so Germany or wherever the seller becomes taxable? 1, number 1, it's a delivery because the machine is a tangible good. The place of delivery is where the transport begins. That's in Aachen in our case, so it's taxable in Germany. 1, number 1. Tax exemption, intra-community delivery. That's usually the case if the buyer has an acquisition. So, number 1, fulfilled. Machine goes from Germany to France. Number 2, the acquirer is an entrepreneur. Yes. Number 3, the acquirer is also subject to acquisition test. Yes, we did that above. Number 4, the acquirer has used the VAT identification number of another member state, not that of Germany. Yes, a French one. So it is an intra-community delivery, so it is tax-free under 4. Number 1B, if the deliverer hands in the recapitulative statement correctly. Okay, so now the last remarks to that case. The tax base is also for the deliverer. The net amount of 200,000 must be declared in the tax declaration and in the recapitulative statement. The taxpayer, so the guy here who does not pay a tax but has to give proofs for the exemption and hand in the tax declaration, is A, our deliverer. The invoice must be written net, so without confirmation of any VAT because it's tax-free. And there must be the VAT identification numbers of both parties involved written down on the invoice. The declaration and the tax declaration is as usual, nothing special. You have to hand in the recapitulative statement for the intra-community deliveries as always. Input tax, well, A keeps the right to deduct raw materials and so on for the machine in spite of the fact that the machine delivery was tax-free. Okay, nothing special. Then we have still left the transaction B to C. So B from Belgium sells to C in Calais. Taxability, yes, it's a delivery. Now this was a delivery without any movement of the good, because when the delivery to B ended, that was already, or then the machine was already in Calais, and there it stays. Just ownership hops over from B to C. That takes a millisecond, and so the place of delivery is here now determined according to the rule for deliveries without movement of the good, 3.7. It's France, because you remember the rule is if there is a delivery where the good which is sold is not moved, then the place of delivery is where that good is at the moment when ownership, or better, the position like an owner, changes. So that's in France. It's taxable in France under French law. Tax exemption, there is none. Especially it can't be an inter-community delivery, even if these people think I have a Belgian VAT number, you have a French one. Well, that all makes no sense, because this is not a cross-border case. It's an internal French case. The good is in France and stays in France. So no export or inter-community exemption. Tax base is the net amount, and now our case doesn't tell us what the price between B and C is. From the perspective of A, that's clear. Probably A will only know that B sells to C, but B will probably not tell A what he charges to C. Okay, but if there is an amount charged, C will pay a gross amount in all probability to B, and that has to be split up into a net amount and a tax rate. And tax, the French rates for these machine. Taxpayer is under the basic rule B. However, you must know that if a foreign entrepreneur delivers something, a member state can also demand the application of the reverse charge rule, so that the customer has to pay. In our law in Germany, that would be a list in paragraph 13b, where we require that. And the French might have taken some other choices there. So there you would have to talk with your customer to find it out. A customer, do you have to pay in your country, or is it our obligation to register in France and pay taxes there? However, one thing is clear, the invoice must be written according to French law. If B is the taxpayer, then with a French taxpayer's number. If it's a reverse charge case, then that would not be necessary. Declaration duties. If B is taxpayer, he has to declare the transaction in France. Nothing special. However, one might mention that for constellations like these, there is a simplification rule obtainable. You might opt, if you are B, for a special treatment of the acquisition under transaction 1 and the ongoing delivery under this transaction here. A so-called triangulation case could be declared. However, that is some special rule which comes far later. I just wanted to mention it so that you don't wonder why I solve it just in the regular way. That was just to save you some complications. And we have heard here is completely possible if somebody does not opt. For example, if he does not know about the triangulation case rules, which often is the case in practice. Concerning input tax, well, B can deduct the input tax from the acquisition tax and probably has no other input tax in France. So that's it. So that was everything already on that small, short, however, medium difficulty case. And now I promise you to stop with exercise cases for a long time, because in the next video we are going to talk about the treatment of cross-border services. we have until now always focused on cross-border deliveries of goods. So cross-border services is a chapter which is still missing, and we are going to close this gap from the next video onwards. Thank you very much for watching. Goodbye, and till next time.